Let's talk money.
Hello and welcome to another brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. The futures and options market almost never ends being in the headlines and in the news. From Sebi cracking down on multiple expiries that both the exchanges were offering us, to tighter regulations overall, to the latest Jane Street saga. Now, I want to focus on this last event that I mentioned, Jane Street, Sebi taking on a global giant HFT, which is high frequency trading, algo firm for alleged market manipulation. So the question is, does this large event and this ongoing legal battle, does it have any bearing on us mutual fund investors? Do we need to make any changes to our investments, to our portfolios? Is there anything to be wary of given the Sebi order? Well, that is what we'll start discussing on the show today. And to do that, I have with me Niranjan Awasthi of Edelweiss Mutual Fund. And in a bit from now, we'll also bring in Misbah Baxamusa of NJ Wealth to talk about overall MF investing trends and where we stand at the end of the first half of this calendar year. Niranjan, thanks so much for taking out the time. I know this is a tricky issue. A lot of people are a little hesitant in talking about it, but we thought it's important to clear the air so that mutual fund investors know what's going on. So first things first, tell us your interpretation of what's happened. We know that this is a big legal case. It's probably going to go on in the courts. And Sebi is looking to impound a large sum of money, almost 5,000 crores, because it feels that this one global entity was, abusing our market framework. Should mutual fund investors be worried?
Right. Thanks, Ruby. Thanks for having me. So my one-line answer is absolutely not. Mutual fund investors should not worry. Thankfully, Sebi has many guardrails and very strict regulation around how mutual funds can participate in F&O market. The issue that has happened has impacted or will impact most likely the weekly option market in India. Mutual fund per se do not usually get into or participate into weekly option market. Largely, mutual funds are allowed to participate in F&O only for hedging and rebalancing purposes. And the participation is largely in the futures market. And if at all in the option market, it is in the monthly expiry market. So weekly expiry market, mutual funds largely do not participate. And hence, there is nothing to worry for mutual fund investors because of this entire issue.
Okay, so that's reassuring to hear that we don't need to worry. But just to understand this a little better, Niranjan, what you're saying is that mutual funds, equity mutual funds, whether it's large caps or mid cap or a flexi cap fund, typically they will not have any participation in the options market. If at all, they might have some hedges, but that's through the futures market. Is that right?
That's correct. That's correct.
Okay. Also, are there any regulations that restrict mutual funds from overall F&O trading? We know that the regulation for mutual funds is far more tighter. It's the new asset class, this, the other SIFs, where Sebi is looking to relax it. We'll come to SIFs later, but just set the rules straight in terms of F&O. What can mutual funds do and what are they prohibited from doing?
Great. So in mutual fund, if you see, largely hybrid mutual funds are usually the ones which trade or take exposure into F&O market. As per regulation, mutual funds are allowed to participate in futures and options only for hedging and rebalancing purposes. No naked exposure is allowed, no leverage is allowed. So if at all a future exposure is taken, it is only for hedging purposes. Even if it is taken in the option market, it is probably a covered call strategy, which is against hedged. At the same time, leverage is not allowed. So even if there is an exposure into futures or option, the overall exposure in the mutual fund portfolio cannot go beyond 100. So the beta that we talk about is basically within that limit of 1. So once the leverage is not allowed, a lot of other risk parameters gets checked. Now within hybrid funds, if you see, there are funds like Balanced Advantage Fund, which take exposure into hedging, into futures for hedging purposes, because they reduce equity level from maybe 70-80% to as low as 30-40%. This reduction in equity exposure is done via taking some future exposure. But as I said, it is a hedge exposure. There is another category, which is equity savings fund. Equity savings fund also use derivative exposure, but again, it is to create an arbitrage exposure, which is completely hedged, 100% hedged. Other funds like multi-asset allocation funds, they may also use derivatives, but again, it is for hedging purposes. So largely, mutual funds, as I said, are allowed to take exposure only for hedging. There is no leverage allowed. Mostly only hybrid funds usually take these exposure. Uh, None of the other equity funds or diversified equity funds usually take exposure to options. They may take small exposure to futures, to take maybe exposure to a stock which is not available in cash today, but usually with an intent to take delivery and not
Okay.
speculative. So
So I
mutual
think that
funds
the
do not take any speculative exposure. They are not
speculative,
allowed to
yeah.
take speculative exposure in the derivatives market.
I think that's a really important headline, and that we should all remember, and all mutual fund investors should keep it at the back of their mind, that mutual funds do not look to speculate and make trading gains with the F&O market. They use the F&O market purely from a hedging standpoint, or like Niranjan explained, if they can't get a cash market stock immediately, then maybe take a futures position with the intent of eventually taking that cash stock and holding it in the portfolio. But Niranjan, I get your point. So the MFs don't play in and out of F&O with the intent to make speculative gains. But given what's happening in the market right now, and that now Jane Street is being told that they need to wind up all their positions, and apparently they had very large positions in the market, could this in the interim impact the hedges that mutual funds have?
So, as I said, the entire issue which has happened is largely related to weekly options. Mutual funds do not participate in that segment. Uh, Whatever winding up may happen will happen in the weekly option segment, and there may be some illiquidity concern, or the volumes would be lower. But later on, this will make up, because there are other participants in market, whether it is AIF or maybe SIF coming into picture over the medium term. However, MF, which usually operates in futures market, almost 80-90% exposure is only through future market. Uh, that is not impacted. Volumes will be consistent out there. And even if it is in the option, it is in the monthly space. So largely, whatever winding up will happen may impact the weekly option. Liquidity may come down, to some extent. However, mutual fund again will stay immune to this, because they are not the participant in that weekly option market.
In the weekly options market, yeah, absolutely. And that's where a lot of tighter regulation is also happening. That's what I was saying, that the regulator has reduced the number of weekly products per exchange to just one a week. Now there is some chatter about whether instead of weekly options, whether it will be made fortnightly. So you don't speculate every week. You limit it to just once in a fortnight. It's all within the realm of sort of chatter and talk. We need to see what the final regulations could be from Sebi on this account. Fair enough, Niranjan. So that point has been driven home loud and clear. But now I want to talk about second-order effects, and if at all that should, worry us. A lot of the capital market stocks were doing so well in the last 12 months. Stocks of brokers, of stock exchanges, wealth management companies, really doing extremely well. Now, with this whole volatility and the whole Jane Street saga, against many of these stocks, including, whether it's exchange names like BSE, etc., or wealth managers, these stocks have started correcting. Now, investors have been writing into us as well, saying, should I be worried? Should I be booking profit? What should I do? Is there a larger capital market issue which will, which will take some time to sort out? What would your suggestion or advice be?
So the entire capital market story, if you see, it's largely structural, right? In the last 3-4 years, especially after COVID, the financialization of saving that has started has actually taken shape. And forget about only broking, right from mutual fund industry to other capital market, whether it is wealth management, have been doing well because of this structural change in the way household savings is getting into financial assets. Having said that, recent times, definitely valuation of some of these capital market stocks have been on the higher side. We've seen some dip in volumes also in the option market, specifically after SEBI taking several steps in last 1.5 year. If you compare last 1 quarter numbers versus numbers in the first half of 2025, there is some bit of drop in the number of trading accounts, in number of volumes, in terms of turnover as well. So that apart from this event also definitely had some impact on the capital market stocks, but I think so that will be limited. the long-term structural story is intact. Coming to mutual fund exposure, because capital market has a very tiny exposure in the overall benchmark. If you compare maybe in Nifty 50, it's negligible. In Nifty 500, the exposure to capital market or this particular space is not beyond 5-10%. With that, most diversified mutual funds have very limited exposure to capital market if you see in the overall scheme of things, and that makes it quite evident that the overall impact in diversified mutual fund will be limited. In which case, these are all active funds. Most fund managers are also not heavily overweight on capital market as a segment if you see the industry wide numbers. So the impact, I think so, would be limited as far
Okay.
as diversified MF or mutual funds are concerned.
Okay, all right, fair enough. So there's some food for thought there for our viewers. Let me bring in Mr. Misbah Baxamusa of NJ Wealth into the conversation as well. Mr. Baxamusa, thank you for joining in, and for the benefit of our viewers, I do want to point out that NJ Wealth is among the largest, probably the largest mutual fund distributor in the country. So obviously a huge role to play when it comes to expanding the industry in terms of expanding investor education as well. Mr. Baxamusa, I know you don't want to directly comment on the issue, but I'm just wondering, because we've been getting a lot of queries from viewers. Viewers are curious. They want to know whether this whole Jane Street issue is just it's an issue for the courts, it's an issue for direct traders, or whether from a mutual fund standpoint, does it impact anything as well? And apart from this, overall, the F&O market, I mean, on and off, like I've been saying, a lot of issues, a lot of regulatory action. Have you been getting any queries on this from your client base?
Yeah, very good morning, and thank you, Surbi, for inviting me. So, I've been also been reading the Jane issue in the media. But to be very honest, we being an organization which has been promoting mutual funds and systematic way of investing into mutual funds and not offering derivatives on our platform, we have never got a query as to what's really happening from our large base of investors. But I think so few things that we have to learn from this particular issue which is popping up, that and again I think so Sebi had been publishing the data of the extent of the loss the F&O traders have been incurring in the last last 3 financial year data they have been consistently publishing, and the kind of losses the investors are making out, investing into F&O. I think so it's a big learning for the young generations who have been investing through this F&O market, that invest into equity is not very simple, or probably making money from it in a very short period of time is just a fancy. If you really want to make money from your investments, you have to be very disciplined, long-term, systematic, and probably mutual fund is the best investment vehicle. So I think those are the learnings rather than worrying about, because as my colleague previously also said, that mutual funds are not affected by this particular event, and that's what the beauty is, that our regulations are so strong in mutual funds. And probably we have an history now of nearly 30 years of the regulation in place, and we don't have any instance in mutual funds which have occurred in the last 30 years, which is of worry to an investor, and people have made money out of it. So
Yeah.
Yes, I think that these are good learnings which with the young investors should take from such events and try to probably change their investment habits.
Absolutely, and Sebi has been really going over again and again with its study, and that's the findings of the study, by the way, are very consistent. Almost every year, Sebi's study says that 90% plus retail traders end up losing money in F&O, and in fact, this year's study is telling us that the losses are going up. The losses have increased 40% this year, which brings me to a final point on this whole issue of F&O and how we investors should look at F&O, is the whole concept of SIFs. These new investment funds that the AMC world is going to launch, and these will be far more sophisticated than plain vanilla mutual funds. And we just heard, Niranjan, you were telling us that mutual funds cannot take very sophisticated speculative positions in F&O, but SIFs will be allowed to do that. So then what would your thoughts be? I mean, is it a right time, or maybe it's not such a great time to be launching SIFs till our F&O market stabilizes and the regulation stabilizes?
Not really, Surbi. If you see, SIF also comes under the gamut of mutual funds, and SEBI is again put very, very tight guardrails when it comes to SIF as well. Only one difference, which pertaining to F&O trade, and the difference between MF and SIF is that SIFs will be able to take 25% exposure, up to 25% exposure to naked shorts, whether it is in the futures market or they can write options in the option market. Uh, this 25% has to be part of the portfolio. Again, here, they haven't allowed leverage. Most speculative trading happens because there is a higher leverage available in derivative market for retail investors. Even in SIF, the gross exposure, the total exposure of the portfolio will not be allowed to exceed 100%, which means if you have 100 crores in your portfolio, 75 crore can be invested in equity shares or stock, cash market. Remaining 25 crores can be used for hedging purposes, for taking naked short exposures. But again, the overall exposure cannot exceed 100 crores. That itself is a big, big guardrail, which means even SIFs cannot take speculative exposures into derivatives. In fact, most SIFs, like the one which we are looking forward to launch, is in the hybrid space. And the intent over there to use derivatives is to reduce equity risk and bring down beta from 1 to maybe 0.5 to 0.6. So within SIF, the beauty of SIF is it allows fund manager and AMCs to launch differentiated product because 25% naked short is available. But at the same time, it does not allow to take any speculative exposure. It does not allow to take any leverage. So as I said, there are very, very tight guardrails. And I don't think so the current episode will impact the way SIF strategies will be launched. In fact, I would urge more retail investors to come in, or especially ones who can invest more than 10 lakh, come into SIF route if they want to, test the waters of derivatives.
Let me quickly take maybe a 30-second view from Mr. Baxamusa on this, because like I said, NJ has been one of the largest distributors in the country when it comes to plain vanilla mutual funds. What about SIFs, Mr. Baxamusa? Niranjan is making a strong case for them because they'll be far more regulated rather than me as an individual investor trying to dabble in F&O and do all kinds of pluses and minuses. Maybe it's better to let experts do it for me. There's a strong argument there. Your quick thoughts on whether we're ready for SIFs?
Very honestly, Surbi, at this juncture, we as an organization are also in process of understanding SIF. And but our core philosophy is that globally and even in India, the structure of mutual fund is so simple, so efficient. From a regulatory framework, is one of the best structure an investor could have. And in India, currently only 5 crore investors have invested into mutual funds. So as far as we as a distribution house is concerned, we see that a lot of things currently needs to be worked in making investor understand this concept and try to get more and more people invest into mutual funds to really bring in the financial inclusion. As you rightly said, yes, SIFs are going to come in. We will understand it. But I strongly believe that it will never be a very core product in the investor basket. Probably it will be a pudding or probably some small portion, depending upon a certain need of certain investors, will definitely get fulfilled. But we need to see and understand it more detail before I really comment on it.
No, absolutely. And let me plug in our earlier episode of Let's Talk Money here as well. Viewers, in case you want to know more about SIFs, because you'll be hearing a lot more about these specialized investment funds in the months ahead. Check out our playlist on YouTube, because we've done a full show on what are SIFs, what are the kind of trading strategies they're looking to deploy, whether their returns will be better than MFs. So do catch that show as well. But for now, a quick break. Then we talk about some of the other trends that MF investors can watch out for the remainder of 2025.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we're discussing what the ramifications of the Jane Street episode could be, if at all, on mutual fund investors, and our guests agree that it really is not a issue of bother at all for MF investors because MFs are very, very tightly regulated and they do not speculate in the futures and options market. So, gentlemen, let's move on to some other thoughts. I mean, overall, what we've seen in the last couple of months, still actually the June data, which just came out this morning, is that total equity flows coming into mutual funds, they were dwindling. I mean, from highs of 40,000 crores every month, we had come down to about 19,000 crores in May. Now it's recovered to about 23,000 crores in June. But really, what are we in for? Mr. Baxamusa, if I could come to you, NFOs were pulling in a lot of money in 2024, up until a couple of months back. What are the big trends that you see ahead in terms of more offerings and investor appetite? I mean, do you see us getting back to MFs pulling 40,000 crores in equity funds every month?
See, to my understanding, most of the time in mutual funds, the major flow into mutual funds, the major source had always been SIPs, right? And if you see the trend, SIPs are continuously increasing. So at an industry level, we are now at around 28,000 crore of SIP. So without much of doing, this 28,000 crores are expected to come in. Now, from a per se level, as I previously also said, the crux is not about that level of 40,000 going to 28,000. In the past also, we have seen some periods where the money have dwindled and again picking it up. So that's a very normal, natural phenomenon of a market where at some point of time, money automatically increases or at some point of time, it goes down a bit. But I think so from a very long-term perspective, the need of an hour is that how we are able to make more and more people participate into mutual funds. And to us, SIP is the most logical way for participating into the equity markets because it's the only way where at every level, if the markets are going up, investors are happy because their values are going up. If the markets are going down, again, it's a win for an investor because you are gaining more number of units, right? So I think so the SIP had been the heart of this industry, and it's very, very good that that particular thing is growing very, very steadily. The time is coming that at what high speed we are able to increase that SIP, how we are able to reach to more number of investors. That would bring in a lot of consistency as to how money is coming into the equity markets, and that will give the stability to the market also. And probably from an investor perspective is also a great win-win over a longer period of time. So as an organization at NJ, we are just working on to, spreading the awareness about mutual funds and spreading the awareness about the simple concept of SIP. And and it's very, very pleasantry to see that number overall in the markets are going up.
Yeah. No, absolutely. Niranjan, final thoughts with you in terms of what can investors expect from the industry for the remainder of this year. Like I said, lots and lots of passive launches have been happening. In fact, even now, when I look at the NFOs, mostly it's happening on the passive side. Once in a while, we get a large, actively managed fundraise. But what should investors expect from you guys in the coming months?
Right. So I think so. The industry will keep coming up with innovation and multiple fund launches as the time fits for the investors. And I think so, as you said, the number of launches has come down drastically. Most importantly, what the point to note is in the last 6 months, it has been a challenging months for mutual fund investors. And at the same time, it's quite heartening to see that SIP numbers continues to be very, very strong. Which shows that retail investors' faith in mutual fund has just started, has been very, very strong. As far as NFOs are concerned, I think so, yes, passive launches will be there. But I think so a large part of, product gaps have been filled in last 1 or 2 years. That also could be one of the reason why, the NFO pace has come down. Passive, yes, there could be a lot of innovation that can come in, especially in the smart beta phase, because largely the plain vanilla index funds or ETF offerings are full today. But yeah, I mean, let's see how the time goes. And most importantly is investors should continue investing in their existing funds. And at least from that perspective, we are seeing the trends being very, very healthy.
Okay. All right. Well, investors are keeping the faith. They're still making a beeline, for instance, for a lot of mid-cap and small-cap funds. So there's enough appetite out there. And let's see how the markets also shape up in the second half of the year. Gentlemen, thank you very much. A helpful discussion. Lots of perspective there for all the mutual fund investors in the country. Thank you for joining in. And viewers, keep sending us your feedback, comments, and queries. Tell us if you want us to address any newer topics. And we'll see you again on the show next week. Thanks for watching.
Let's talk money.